How the world's wealthiest level up during a crisis. Hey everyone, today I want to sit down and share a truth about money and investing that most people rarely discuss openly. Many people freeze up when they see the market dipping or the economy getting shaky. But in reality, the wealthiest people I've studied and followed treat these moments as their golden ticket to break through. The cost of standing still. There is a quote I always live by. Action comes with risks and costs, but they are nothing compared to the long-term cost of comfortable inaction. If you just watch from the sidelines because you're afraid of losing a little, you're actually losing the chance to change your life forever. To me, investing isn't just about watching numbers go up. It's about freedom, being able to do whatever I want for the rest of my life. The crazy strategy that actually works. It might sound strange or even a bit backwards, but the best strategies often go against the crowd. When everyone else is running away in fear, that is exactly when the smartest investors are quietly stepping in. Look at the world's top billionaires. Carlos Slim Helú, he snatched up telecom and energy companies at bargain prices when the markets were at their weakest. Warren Buffett, the master of compound interest, he bought into incredible companies like Apple and Coca-Cola when they were priced far below their true value. Lakshmi Mittal, he built a massive steel empire from the ruins of old factories in Eastern Europe. The common thread? They didn't wait for things to be perfect to invest. They invested to make things perfect. The small investor advantage, that's us. I hear a lot of people say, I don't have millions like them, how can I even start? But here's the thing, having less money is actually a massive advantage. Why? Because when you are small, you are agile. You can move in and out of promising stocks or small tech companies without shaking the entire market. Warren Buffett once admitted that his highest returns came in the 1950s when he was managing very small amounts of capital. Back then, he could crush the market indices because he was flexible. I've used this exact mindset to build my own portfolio across biotech, software, and private ventures, and I truly believe that if you're willing to put in the interesting work of learning this strategy, you'll discover that success isn't just a stroke of luck, it's a foundation you build for yourself. Don't wait for the clouds to clear. Get your strategy ready now, so when the next storm hits, you're the one rising up, not the one being swept away.
The secret of accumulative buying. Why I love it when stock prices drop. It sounds simple, but in reality, it is an art of gathering, collecting, and preserving. Most people run away in fear when they see the market bleeding red, but for me, that is the golden opportunity. However, keep one thing in mind. We don't just buy at any price. Don't buy stock tickers. Buy the whole company. The biggest mistake most people make is viewing stocks as just flickering numbers on a digital screen. From my own experience, I want you to stop that way of thinking immediately. When you buy a stock in a business, you are actually buying the right of ownership of a part of that company. If you buy 10 shares of Coca-Cola, you are a co-owner of that beverage empire. You aren't just playing the market. The core of accumulative buying is this. You find a business that you absolutely love, understand deeply, and wish you could own in its entirety. You wait patiently for the stock price to drop significantly to buy in. As long as you have cash and the price stays low, you can keep scooping up more assets at a bargain. Sounds a bit backwards, doesn't it? But believe me, every top billionaire in the world I've studied is a hunter of businesses in exactly this way. They don't care about short-term fluctuations. They care about true value. Make Mr. Market work for you. I've always lived by one hard-earned lesson. View a stock as a business and use market volatility to find your margin of safety. The truth is, so many people enter the market without understanding the mechanics of accumulative buying. They become speculators, or to put it bluntly, gamblers.
They panic when they see their asset value drop, simply because they have no idea what the true value of what they're holding actually is. I want you to remember this throughout this video. A stock is a piece of a business, and you are the owner. Once you embrace that mindset, you have officially joined the ranks of true investors, following the path of legends like Warren Buffett. You know, there are periods lasting nearly a decade where seasoned investors barely buy anything at all. They might sit on a massive mountain of cash and wait patiently. They wait until Mr. Market becomes hysterical, dragging the prices of incredible companies down to dirt-cheap levels. There are times when the market crashes and stock prices drop by 50%. People will attack these investors, calling them old-fashioned or out of touch. But the reality? That is exactly when they pour their money into the game most aggressively. While the rest of the world is fleeing because a bubble burst, those with an accumulative mindset see a life-changing opportunity clearer than ever. The truth is, accumulative buying is something people either get instantly or they never will. No matter how brilliant the results are or how much wealth it generates, the patience and courage to go against the crowd remain the ultimate challenge. Don't just look at the green and red candles, look at the value of the business you own.
Elena was a software engineer in Austin. In 2019, she began her journey with a capital of $20,000. Instead of getting swept up in the daily waves of swing trading, Elena spent 6 months researching the industry she understood best, green energy. Applying the formula, buy the company, not the stock. Elena wasn't looking for a ticker symbol to gamble on. She was looking for a business to own. She chose Solar Tech Dynamics, a hypothetical name, a company with a rock-solid technical foundation that was being ignored by the market. At that time, Solar Tech was facing a massive sell-off due to a minor patent lawsuit, causing the stock price to crash from $85 to $42, a drop of over 50%. She pored over the financial reports and saw that the company still held $150 million in cash, with almost zero long-term debt. Most importantly, the book value of their factories and technology was worth at least $60 per share. Elena recognized this as her margin of safety. She used her first $10,000 to accumulate at the $42 price point, leveraging Mr. Market's euphoria and panic. In early 2022, when inflation spiked, the entire market panicked, and Solar Tech was dragged down further to $35. Contrarian mindset. Instead of fearing the drop, Elena viewed it as a clearance sale. She took an additional $5,000 from her savings to buy more. Her average cost per share dropped to approximately $39. The power of patience. For 3 years, Elena didn't check the ticker every day. She only tracked Solar Tech's revenue, which continued to grow steadily at 15% per year. Sweet success. The numbers speak. By late 2025, as the green energy sector boomed and the old lawsuit was settled in the company's favor, Mr. Market turned euphoric again. Stock price. Solar Tech soared to $185 per share. Profitability. With an average cost of $39, Elena's investment grew by 374%. Total assets. From her original $15,000 investment in Solar Tech, she now holds a position worth over $71,000 in that stock alone. Combined with other accumulative investments using the same formula, her total portfolio hit the $160,000 mark after 6 years. Elena no longer worries about market fluctuations. She shares, "I didn't buy green and red numbers. I bought Solar Tech's factories, their patents, and their engineering team." When you know you own a high-quality money-printing machine, you hope the price goes down so you can buy more. You don't run away. Elena turned the market from a casino into her own discount supermarket. Distinguish between price and value.
Many people lose money because they think the market price is the true value of the company. That's a mistake. Price is the amount of money you pay, but value is what you actually get in return. Imagine you are buying a used car. The seller asks for $5,000, but you have to check the engine and the body to know if it's actually worth that much. Investing is the same. The only secret here is only buy when the market price is much lower than the business's true value. When you do this, you essentially eliminate risk and secure your win. Leverage Mr. Market and find your margin of safety. The market is like a character I call Mr. Market. He is purely emotional, sometimes overexcited and other times utterly panicked. I've learned to use those fluctuations to find a margin of safety. I once had an experience buying a horse. To an outsider, he looked thin and out of shape. The previous owner wanted to sell him quickly due to debt and pressure. But someone with experience looks at the bone structure and internal potential to know he is actually a prize-winning horse. In investing, when the market is gloomy, surface-level issues can cause prices to crash. But if the core value remains unchanged, that is exactly when I put my money to work most aggressively. The 10-10 rule, the power of patience. I want to give you a golden rule from my own experience. If you aren't willing to hold a stock for 10 years, don't even think about holding it for 10 minutes. Why? Because investing is a long-term story. It forces us to look far ahead. It helps us stay calm even when we are stuck in a terrible market for years. You can't know exactly when you'll strike it rich, but if that business continues to generate profit, the day you harvest the sweet fruit will surely come. I only want you to understand one thing. Accumulative buying is something people either get instantly or they never will. Stop staring at green and red candles every day. Look at the value of the business you own. When you master your psychology and understand the value of what you buy, you'll see that the market is no longer a risky casino, but a discount supermarket just for you.
The secret behind the accumulative buying strategy. Why I get excited when the market goes down. I want to share a mindset that completely flipped my financial situation. Many people ask me for my secret, and I simply call it the accumulative buying strategy. At its core, it means gathering, collecting, and preserving assets over the long term. To me, buying a stock is buying a piece of a business. If you own a few % of the shares, you are a shareholder. If you buy all the shares, you become the owner. Regardless of how much you buy, your mindset must be that of a business owner. For example, if you buy 10 shares of Coca-Cola, think of yourself as a co-owner of that beverage empire, not just someone playing a ticker symbol. The paradox of wealth. Lower prices mean higher benefits. It might sound strange, but I actually wait for stock prices to go as low as possible. Why? Because when the price is lower, I can buy much more with the money I have. When you know for a fact that the true value of a company is $20, but the panicked market is selling it for $10, $5, or even $1, that is a golden opportunity. Continuing to buy as the price drops helps lower your average investment cost per share to an extremely low level. The incredible power of compound interest. Albert Einstein called compound interest the eighth wonder of the world, and I utilize it to the fullest through accumulative buying. In accumulative investing, there is no upper limit to compound interest. The cheaper you can buy, the higher your compound interest rate becomes. Take this example. If you lend $60,000 at 10% interest per year, after 5 years you have $100,000. But if you use that $60,000 to accumulatively buy a great company when the price is crashing, after 5 years, that money could turn into $520,000, equivalent to a 54% annual interest rate. That is how I explode my profits. Lessons from the legends.
I always watch the world's wealthiest people, like Warren Buffett or the billionaires on the Forbes list. They are all master accumulative buyers of businesses. From the late 90s to 2008, Buffett was extremely patient, sitting on tens of billions in cash, waiting for the right moment. When the market collapsed in October 2008 and the world was fleeing, he poured billions of dollars into public companies. He leveraged market fluctuations to find a margin of safety, exactly what Benjamin Graham taught us. Even if another 100 years pass, this will always be the foundation of value investing. Patience is the key. Many people give up because they want to get rich quick, but I choose to look far ahead. Accumulative buying reduces your risk because you clearly understand the value of what you're purchasing. You don't need to worry when the price goes down in the short term. Remember, eventually, price and value will meet as surely as the sun rises tomorrow. In this video, I hope you begin to embrace this mindset. Once you master the secrets of compound interest and the patience of accumulative buying, you have taken your first step on the path to becoming a great investor.
People often ask me, why is it that when a stock price crashes, say from $10 down to $1, and everyone else is sprinting for the exits, I'm calmly buying in like I just found a diamond in the rough? Many assume I must be some kind of genius or have a superpower to go against the grain like that. But here's the truth. You don't need to be a genius or have a sky-high IQ to build wealth through investing. Here is what I've gathered from my own financial experiences. The battle between logic and emotion. Investing isn't a battlefield between the smart and the clueless. It's actually a tug of war between the crowd's emotions and your own logic. The method of accumulating assets is mathematically simple, yet psychologically demanding. The biggest obstacle most people face is pure fear. When prices drop, human instinct screams panic. But if you can remain calm while everyone else is losing their heads, that is exactly when you start walking the path to true wealth. Don't be fooled into thinking that professional fund managers, the big guys who control over 85% of the market's money, are always rational. In reality, they're under immense pressure to deliver short-term results. If a stock doesn't go up in a few weeks, their clients threaten to pull their money. They fear for their jobs and their reputations, so they often follow the crowd just to feel safe. That fear drives them to do the exact opposite of what they should. When they should be buying at a discount, they sell out of fear. And when prices are sky high, they jump in out of greed. You and I have a massive advantage. We don't have those pressures. We have the luxury of patience and emotional control. Treat a stock like a real business. This is the core lesson I live by. Stop looking at the flickering numbers on a screen and start looking at the actual value of the business. When you own a stock, you aren't just holding a ticker symbol, you own a piece of someone's company. If that business is solid and well run, a temporary market crash is simply a wholesale opportunity for us to buy in at a bargain. The wealthiest people in the world got there by owning businesses, and investing is your shortcut to doing the same. If we control our fear with knowledge and sound reasoning, we win. Be ready to buy when the crowd is terrified. Be ready to sell when the crowd is blinded by greed.
When the market goes down, that's when we go up. People often ask me, all these investment theories sound great on paper, but do they actually work in the real world? Let me tell you straight, what I'm about to share isn't just theory. I've lived it, I've done it, and I've seen the results firsthand. You might think, maybe he just got lucky. But if I told you that the wealthiest people in the world, take Warren Buffett for example, built their fortunes using this exact same mindset, would you want to know the secret? The hamburger story and the reverse joy. Let me ask you a very simple question. If you plan to eat hamburgers for the rest of your life, but you don't own a cattle ranch, do you want the price of beef to go up or down? Similarly, if you're someone who wants to buy a new car every few years, but you aren't a car manufacturer, do you want car prices to be more expensive or cheaper? The answer is obvious, right? We always want the price of things we need to buy to go down. Yet there's a funny paradox in investing that I see many people fall for. You plan to accumulate stocks and assets over the next 5 to 10 years, which means you are a buyer. But every time the market crashes and prices drop, you get anxious and upset. On the flip side, when prices skyrocket, you celebrate and jump in. It makes no sense. You should only be happy when prices rise if you are a seller. If you are a buyer looking to build wealth, you should be praying for the market to cool off. Market downturns. Some lose, others win big. Every time the headlines scream, "Investors lose billions as the market plunges," I usually just smile and correct it in my head. The non-investors are losing money, but the real investors are about to make a fortune. There's a truth that people often forget. For every person selling in a panic, there's someone buying with a plan. What hurts one person creates a massive profit for another. In my experience, the years when the market is the most brutal are exactly when gold is lying right there on the ground, just waiting for someone with the guts to pick it up. The wealth-building opportunity in a crisis. Imagine you're standing in the middle of the California gold rush of 1848. While everyone else is panicking or giving up, the real gold nuggets are actually sitting right there in front of you. A weakening market isn't a disaster, it's a golden window to buy great assets at dirt-cheap prices. A small effort during these times can bring you a fortune far greater than you could ever imagine later on. In short, the secret boils down to just one thing. You have to be able to tell the difference between fool's gold and real gold. Once you learn how to identify valuable assets, your job when the market goes down is incredibly simple. Just pick it up. It's right there, right in front of your eyes. Just pick it up.
A great business is a gold mine. Think of a truly great business as a real-life gold mine. But this isn't just any mine. It's a special kind that doesn't just sit there. It constantly produces more gold over time. The secret here is accumulative buying. When you find a fantastic company that the market has undervalued, it's on sale. That is your moment to miraculously boost your rate of return. If you stay disciplined and keep accumulating while the price is even lower, your returns truly turn into pure gold. The magic of compound interest and the rule of 72. There's a simple tool I always use to calculate how fast wealth grows, the rule of 72. How it works? Simply divide 72 by your annual interest rate. The result is the number of years it takes for your money to double. Example, at an 8% annual return, it takes $72 divided by 8 equals 9 years to double your money. However, if you hit a 24% return, which is totally achievable if you pick the right businesses, it takes only 3 years, 72 divided by 24, to double your capital. Beating inflation. This rule also keeps you sharp regarding inflation. If inflation is at 3% in 24 years, 72 divided by 3, the purchasing power of your money will be cut in half. Understanding this makes it clear, by not investing, you are essentially choosing to get poorer. Why small but mighty? Many people feel insecure because they start with little capital, but I'm telling you, the smaller you are, the more agile you are. Even a legend like Warren Buffett admitted that back in the 1950s, when he was managing a small portfolio, he could generate returns of up to 50% a year. Why? When you manage billions, you're forced to buy giant companies where competition is cutthroat. When you are small, you can pivot into niches and buy high-potential stocks that big funds can't touch because their size makes them too clunky. Imagine playing basketball against a superstar like LeBron James, but he's carrying a 400-pound anchor on his back.
That's exactly what big investment funds look like compared to you. Our agility compensates for our lack of massive resources. What should our goal be? Personally, I aim for 24% annual return. It might sound high, but with an accumulative buying strategy and our small-scale flexibility, it is a goal well within reach. Don't listen to anyone who says it's impossible. If you start with $50,000 and stay consistent at this rate, in 20 years you'll be holding millions of dollars. Trust me on this. Don't wait until you have a fortune to start investing. Start now. Leverage your small player agility and let compound interest do the heavy lifting for you.
There's a quote I always keep in mind whenever I start a new venture. Whether you think you can or you think you can't, you're right. It might sound like a cliché, but in this volatile financial world, your mindset determines whether you are the hunter or the prey. Many people out there will tell you that managing your own investments and building sustainable wealth is impossible. But look at the facts. Even the big shots on Wall Street, the ones calling themselves experts, can go bankrupt by the dozens in a single year. Remember the 2007-2008 era, when the derivatives market swallowed trillions of dollars? Even the most seasoned money managers were left helpless. So, never let anyone limit your potential. If you want to find gold, don't wait for someone to hand it to you. Go out and pick it up yourself. The truth about expert advice. I want to be brutally honest with you. Financial institutions often care more about their own pockets than yours. All those slogans about buy and hold or diversification are frequently just excuses to keep you trapped in a game where they hold the steering wheel. Furthermore, don't rely solely on absolute protection from funds or the government. When the economy overheats due to debt and overspending, you are the only one who can truly save your financial future. To live a prosperous life, you must be the one to grab the shovel and dig for real opportunities. The accumulation investment strategy, my personal approach. Instead of listening to flashy sales pitches, I choose to invest like a business owner. Here are the 4 core steps I always follow. Valuation is key. I always aim to determine the intrinsic value of a business. I only buy when the stock price is significantly lower than its true value, buying a great asset at a bargain price. Patient accumulation. Once I've identified a target, I continue to buy as long as the price remains cheap and I have the resources. The 10-10 rule. This is a crucial filter. Never own a stock for even 10 minutes if you aren't willing to stand by it for 10 years. Know when to exit. When the stock price rises well above its intrinsic value, that's my cue to sell and harvest the profits. Final advice. One ironclad rule. Only buy what you truly understand and what has meaning to you. Don't let anyone fleece your wallet by taking advantage of your gullibility. Bring a cool head and get ready to dive deep into practical investment methods with me in the upcoming sections.